Hey folks, welcome to Your World with Prakash Kapila. In this episode, we'll have a very good deep dive into the things that is raging across the world right now. That is with respect to the financial systems, with respect to U.S. Financial system, particularly the small banks, and we will be going into the details of what happened with Silicon Valley Bank, especially because that is the biggest bank failure so far, and what actually happened and how it all turned out. What are the events that happened? And uh, what is the solution for it? Okay, so to give you a brief idea, around March 8th, the stock price of Silicon Valley Bank, SIVB, it was around $108, $110. March 8th. By March 10th, it became zero. March 8th, it was more than $100. And March 10th, it is total zero. What is the market cap? $6.8 billion. $6.8 billion wiped out in one day. That is the market cap. Market cap means the value that shareholders or the equity holders give to a particular entity or a company is called market cap. The stock price into the quantity of float is the market cap. So to give such a huge fall of close to $6 billion, 6.8 or $7 billion is unprecedented, and it didn't happen for like a lot of time, except that of like Citigroup way back around 2008, 2009. You can't find such a huge drops happening in the recent past. So why did this happen? This happened because there was a bank run. Okay. Now, what is a bank run? A bank run is like COVID for simple reasons. When COVID comes, a person dies, a Delta or something like that. If COVID catches, the person dies. And before the person dies, the COVID actually multiplies within the body, right? So like that, that's called contagion within the body. Now that contagion happened on a scale that Silicon Valley Bank couldn't sustain. So in span of just 5 to 6 hours, there was a drop of $42 billion. $42 billion were wiped out from the bank assets. So that means a lot of people just took out those money all of a sudden. Now, why did this happen? Why did all of a sudden someone took out the money and went away? We take one step behind that. So on March 9th, people started taking out money, and so the stock price fell. So before March 9th, March 8th, the company said that we have faced $1 billion loss, $2 billion losses, and we are going to need to raise capital. We will sell some stock and we'll raise a capital, $2 billion. So for this $2 billion, why did $42 billion go away in just one day, just a span of hours? That is the crux of the problem. Just like you have a contagion hitting the bank, the depositors' money was taken out by the depositors in droves using technology, right? So once a person decides in mind that my money is hard-earned money is going to be evaporated, then they will start panicking, and then they just want to protect whatever money that they can have and go ahead with it. So that's why a lot of people started pulling off their money. And um, we take one step back. So many people started pulling off the money, but even if so many people pulled off money, it's still like 42 billion. How could so many? How could few people, or in just span of 6 hours, how many people can take out the money? If you think in those terms, then you will think that okay, for one, um, uh, for like 6 hours, few people wouldn't have been able to do that. So it trickled from few people to few people to few people to few people to like many people, and therefore they were able to take it. And also, the bank itself had got few customers who had a lot of money. So the around 2019, it take one step behind the present run, and you see that in 2019 the bank had around $50 billion. By 2022 or 2023 January February, the bank has got $200 billion. From $50 billion, it went to $200 billion. And this particular exponential growth happened because the bank started soliciting venture capitalists. See, every bank or every business for that matter has to differentiate itself from the existing players. So no bank could say, oh, I'll operate like JP Morgan, because that bank is not like JP Morgan. So what risks, or uh, for JP Morgan, it doesn't need to take much risk to earn money. But for small banks, you need to earn money. You need to really go to the market, convince people not to put money somewhere else and put in your own bank. And therefore, there needs to be a unique selling promotion, USP, for each individual bank. They cannot just go there and say, hey, Bank of America is giving you credit card. I'll also give you credit card with the same facility. Then nobody's going to budge. Nobody's going to care. In the same way, they can't go and say, just like Citibank is giving you loan, I'll also give you loan. Take loan from me. Nobody's going to take that. They'll say, if Citibank is giving loan, why should I come to you? So therefore, it is imperative. It is imperative for any bank to differentiate from big banks, particularly small banks, because people trust. There is an inherent trust among depositors with big banks. They will go to the big banks, whereas small banks need to really work hard to get the depositors. So what do? They do. There are a few things that they do. They give good interest on the CDs. They give good interest on the mortgages. That is, if Bank of America is giving mortgage for 5%, then a smaller bank would say, I will give you for 4.5%, a little bit lesser than big banks. So why do big banks have that higher interest rate? Because they don't care about individuals, right? Individual companies, individual people, they have a lot of people. They have a lot of deposit loanees who want to take loan from them. So therefore, they don't care. And also the amount of risk that is there for a small entity versus a big entity. A big entity risk is small. Even though money is more, the risk is small from banking terms. Okay. So think about it like this. Should I give you $100, or should I give a rich person $100? Where is the probability that I get $100 back? Maybe with both of them, but if you had to give those $100, you would prefer giving it to a richer person than a poor person. So that's how banking system works. That's how the risk management works. The credit worthiness is what, if an entity has more money, they have more credit worthy. So therefore, these big banks would like to give loans to big people, big companies, and so on and so forth. So what these small banks do is they go to the individuals, they go to the small companies, small businesses, and they start pitching themselves as someone who can give you specialized service, either in terms of reducing the interest rate or in terms of your deposit getting more money. So if you give me money, I'll give more interest than, say, JP Morgan. If you take money from me, I will give you less, I will charge you less interest than JP Morgan. So that's how these small banks can attract people. So a lot of people saying that, okay, the small banks became greedy and therefore they gave good interest. No, if the banks didn't give lesser interest, nobody is going to go to them. And the servicing of small people and small businesses will become very difficult. So a lot of mortgage companies, a lot of people who do mortgages, companies that do mortgages, they give a good interest, they give an attractive interest, which is lesser than what a big bank gives. And then they securitize that and sell it as a mortgage-backed securities to big banks. So this is normal business process. So Silicon Valley Bank charging a less interest for loan is not uncommon. Every small bank will charge lesser interest than big bank. That is the bottom line. Otherwise, nobody will even look at them. Number one. So number two is these Silicon Valley Bank. What did it do? It went to these venture capitals and it said, "Hey, you can put money with us. We'll give you attractive interest on the loans you take, and we will also give loans on your illiquid. That means not the stocks that they can't sell outside on free market. Those stocks also we will evaluate and we will give loans on them." So illiquid securities like your stocks, your bonds, and your entire checking account, if you give to Silicon Valley Bank, you will get good interest on your loans. You will get good purchasing power on your loans. So that is the bottom line in which Silicon Valley Bank was able to amass a lot of wealth. So not only were the venture capitals given that option, the companies under that venture capital. So if one venture capital has, say, 10 companies with them, and each of these companies has again a 10 or 15 employees, then the Silicon Valley Bank said, you as well as your companies as well as their employees, I want all of their accounts in my bank. So that is the deal. So then the people who had, everybody wants good interest, right? It's a hard-earned money. If someone is, the interest is also not humongous, right? Someone is giving at 5% and you're giving at 1%. Someone is charging 5% and you're charging 1%. No, it's not like that. It was more like someone is charging 2% and you were charging 1%. So there was like almost similar, but not hugely exaggerated interest rate. Therefore, all people started putting their money into Silicon Valley Bank, all the venture capitals and the companies and the employees and their friends. So venture capital, their companies, and each individual employees of each companies and their friends, all of them started putting money into Silicon Valley Bank. So what happens when one venture capital guy says move, then all the company within that venture capital and all the people working for the company, all of them move in one row, in one instant. So therefore, The fall of $42 billion within span of 6 hours, or how many hours, happened because all of them moved in a drove. And added to that, there is a public information called 8K that the Silicon Valley Bank had to file. So previously, a lot of people didn't know what was happening in banks, what is 8K, what is 13HR. Only finance guys and wealth professionals used to know. But with internet, with YouTube, with Facebook, everybody started, understanding what this is, and they figured out that this is not rocket science, right? 8K is not a rocket science. 13 HR is not rocket science. These are all documents that every company has to put in the SEC website. So everybody has access to it. Even you can have access to any company's 8K, sitting anywhere in the world. SEC can you just have to go to sec.gov. You say I want this company's 8K, and you will get that 8K document. So the information previously unknown to normal people is now known to normal people who can identify what is. I mean, the people who are venture capitals, people who are having their own companies, they're smart guys. People working in startup companies, they're very smart guys. They do understand things very quickly. So this is not like your, say, for example, a software engineer in a normal company and a software engineer in a startup company. A software engineer in a startup company can easily understand things more quicker because they are exposed to different things in their day-to-day job activities. Whereas in big companies, these software engineers or these professionals are only limited to that particular area. Since these guys have a varied knowledge, they are quick learners and they can easily understand what is happening. So all of a sudden, you have a lot of traders. These software guys, they are all traders. They're not. They became traders, and they say, "Okay, I mean, I understand that you need money, so I am not willing to give you money. I just have to pull away my money." So like that, all the people started moving the money. They're all smart people. They understand the financial aspects, and they move money very quickly. That's the difference. That's the second difference. The third difference of why this happened in such a quick succession, in such a quick way, third point is everybody can now just move the money by a click of a button. So the movement of money, you don't have to go to the clerk, you don't have to go to the teller and take out the money. You just have to open your mobile and do whatever. The other thing is there is social media, YouTube, Facebook, WhatsApp, you name it, TikTok, you name it, right? So any information that is there somewhere is percolated across the people. So all these things add up to one thing in marketing, which we call word of mouth, right? So few of the, say, for example, a good movie has come. A lot of people will say, hey, this is a good movie. And everybody will start watching that movie, and the movie's revenues go up within 2 days, within a couple of days. So like that, with the good word of mouth, the information about Silicon Valley Bank spread across like a wildfire. And also media. So media has to report what is happening, right? So people looked into different aspects of the media reports everywhere, the Facebook reports everywhere, YouTube channels everywhere. Then they collated each 1 + 1 and say, hey, this is 2 and this is not, or 1 - 1, it is becoming 0. So before it becomes 0, let's move on. That is what has happened. So what should have happened to the banks is not after the information has gone away. It should have happened before. Now, when it was happening before, there were other players in the mix called Fed, FDIC, which did not supervise the things properly, and it was not implemented properly. That's what the FDIC vice chair, FDIC chair, as well as Fed vice chair have said in the meeting today in Congress and in Senate. So that apart, we'll go into that later. So why did this need happen that it had to raise money all of a sudden? So here comes the most important part. The bank did not invest in risky, that means high returns, high losses kind of security. We call it securities, but it's more like bonds or stocks, right? It didn't do that. What it did, what Silicon Valley Bank did was it invested in US treasuries and mortgage-backed securities. How much did it invest? It invested 85% or 90% of its total deposits that it had into these securities. Okay. So they took the money that is there in checking account and they put in these securities where they get some returns on that. And the mortgages that they had with these big people, they sold those mortgages. They had those mortgages in place. So like any other mortgage or any other security or bond, if you wait till the maturity, maturity means the time frame. Say you bought a bond saying 2 years. Now 2 years will 2 years. If you are able to have that bond with you, then you get some extra money. You put $100. You wait for 2 years to get $100 plus. If it's a 2.5%, it is 1 or 2.5. Or you buy treasury bills. Instead of paying $100, you're paying $98, but you get $100. So like that, it is there. So whatever money you put, you get extra money. The money you put, you get extra. But the important thing is you have to wait for the duration of that particular bond. Now what happened? The interest rate started going up like this, right? The interest rate going like this. The Silicon Valley Bank has bought bonds here, but the interest rate is here. Now, if they had to sell it, they will have to make this loss. This is the loss that happened, right? So what did this loss? They said they didn't have to sell it because they had enough amount in their bank to sustain this till the maturity. Maturity means till the duration. They did not buy a 2-year duration bond. They bought 10-year duration bond. They bought 30-year mortgage bond securities. So that's how this became overbloated. So now the depletion started happening of the amount, of the deposit amount or the amount that they can use to run their day-to-day operations. Now, why did that happen? On one hand, when the interest rate is high, people don't get loans. People don't apply. One, they don't apply for loans. Two, they don't get loans so easily also. Because like I said in the first itself, the credit worthiness, how much money you have, determines how much loan you can get. Money you have, loan you can get. So it is always proportional. When the money you have is same, but the loan you can get is reduced because of interest rate happening. So what will you do? Instead of applying for the loan, what you will do is you will start using your existing deposits. So the deposits is getting reduced, whereas the loan is not being sold. Now comes the bank. The bank doesn't have the money. So the bank doesn't have the money to wait till that duration. So no money is going down. Bank can't wait for the duration. What is the bank going to do? It will go and say, hey, it will go to the market and say, I have this security, it is 2.5%. So nobody is there to buy that for 2.5%. So what should you do? Hey, this is 2.5%. I'll give you 2.5% over that so that it matches with the existing bond that others are buying. So not only did you lose the duration, till what time you have paid, till what time the coupons are coming, you have lost that also. And you have lost the new coupons that you need to pay. Over top of that, you are giving more money to the purchaser. So therefore, the losses started happening, and this loss was not transparent. A lot of people didn't know how much loss it was there. Oh, suddenly on March 8th, they said we have to raise $2 billion. People got scared. Hey, you are saying you're okay, but you are saying you need $2 billion. How is this possible? Right? 8K. 8K, they had to give that document 8K to SEC. This 8K document is available for everybody. Now, everybody is smart enough to understand what is there in that 8K. It's not rocket science. And the money that you have is from sophisticated professionals who are very quick to understand things. So therefore, they understood, they became traders all of a sudden. They had the same knowledge base as a trader would. And then they said, okay, this is my money, I'm going to do, and then gone. That's how the money went out, like very heavy. So what actually happened? So in any bank, or for that matter, any person or any entity, there are few risks that that everybody has to bear. One is reputation risk, how good you are. One is legal risk. Are you good? Are you not criminal? These are all things that we check anyways, right? So are you a good guy? Is everybody saying that you can do the job? Second is, are you fair enough in your dealings? And third one is market risk. And fourth one is credit risk. So what is market risk? Market risk is, say you are a farmer. Okay. Now you have grown tomato. Now you take this tomato to the market. But unknowingly for you, there are other 1,000 farmers who have taken this tomato to the market. So what will happen? The price will fall because everybody is selling. The people will start asking for lesser and lesser money. So the price will fall. When this is called market risk, right? The market is determining the price to come down for a price that you thought when you started some production. This is the price you thought, but the market made the price fall. So this is called the market risk. You have to bear the market risk. All the farmers do it. All the manufacturers do it. Except the financial service guys, everybody else has to do it, or software guys and financial guys. Except them, others have to do it because the services given by, say, a good doctor is there, right? You don't care how much the other doctor is charging. You want to go to the good doctor, so you pay extra. A good lawyer, a normal lawyer may charge some X amount. A good lawyer may charge 10x. You still go to that good lawyer because you want an outcome. So in professional services, like a doctor, lawyer, financial services, or software, or IT, there the market risk doesn't work. But in all other things like commodities, the market risk works. In case of bank, in case of treasury securities, that market risk is prevalent because the interest rates is high. You were expecting that you are going to get this much money, but now you are going to fill the gap. So therefore, instead of getting this much money, you are getting this much money. So the delta that is there, the money that you have to put in because the interest rates have risen, is the market risk for the treasuries and the mortgage-backed securities. So therefore, the market risk has come into play because the interest rates have risen. Otherwise, the bonds are good. So when they bought the bonds, right, they were buying the bonds around 2021 or 2020. So 2020, nobody thought that interest rates will go up. 2021, nobody thought that Russia will attack Ukraine. No, so around 2019, 2020, 2021, nobody thought that the rates would go 20 times. So 0.25 to 5% interest rate is 20 times. And every time, and also it was not known. And even if Powell is your friend, Fed chairman is your friend, they won't tell you, right? I'm going to raise rates before the raising rates. It's all secrecy. So nobody knew what the end rate was. What the starting rate of 0.25, it kept on increasing, and nobody knew that it will go till this much. Everybody thought that from 0.25, oh, you raised this much. Okay, fine. They thought, okay, this is the delta. Okay. Next meeting happened, they raised this much. So it was like a frog in a container, and you're heating that kind of frog in a water container, and you're heating that water. So what will frog do? The frog will not jump because it is getting accustomed to the heat. It'll say, okay, this heat I can sustain, this heat I can sustain, this heat I can sustain. That is what happened with Silicon Valley Bank. They thought that the rates, the end rate would come down. Every media guy was saying that it is going to come down over a period of time. So they thought it is but natural to think that, okay, the rates will come down at some point. So they waited for it, but they waited for more time than they thought. At least they thought, okay, this will be over, we'll be able to sell, the margin of loss will be less. No, every month the interest rates kept on increasing, and by the time you look back, it is 20 times more. 0.25 to 4.75 or 5. 0.25 to 5 is 20 times. Nobody can accommodate, nobody can plan that interest rate will go up 20 times for the rate for which you have bought. That is the biggest failure of Fed, I will say, that you have not told why the rate, what percentage of the change will happen at what time. So you didn't have a benchmark saying that, okay, my inflation is 10. Paul Volcker was there. He raised the interest rates, and he was always saying inflation is high. I'm going to put my interest rates a little bit more than inflation. So everybody was looking at inflation and said, okay, this was accommodated. And even at that time, few banks have failed. So all in all, the risk management of the bank did not accommodate 20 times the increase of the interest rate. It is a bank failure. It is a management failure. Definitely, because they didn't envision this, particularly when they knew that there is something called interest rate risk. So interest rate risk is the market risk associated with the treasury bonds, with the mortgage-backed securities. Everybody just says, okay, fine, because it doesn't raise for 12 years. It didn't raise. How is it going to raise now all of a sudden like that? People didn't accommodate for that, and that's a fault by the management. So now, is this? So what happened? There was no transparency between the bank. What should have happened? Hey, my securities are at X level. I have to, the market is at Y level. So I have to give the gap of X minus Y. That should have been propagated, that should have been transparent to people and to the risk and to the management and to the board. And they said, hey, this may keep on going up. What are you going to do? Someone is going to ask that. So at that point of time, they would have been forced to either liquidate it early enough or do some hedging on the particular security. They didn't do either of them. and therefore it is the bank's failure. No doubt. I mean, you can't expect the Fed to dance to you. You have to dance to them. Government is not going to dance to you. So they have their own way of dealing things. You should always be in line with what is happening at the macro level. So you should understand those macro levels and you should do it. So what could have been done um, with the so much of interest, with so much of interest rate hikes, so much of interest rates going up? What could have been done? What should have been done? First is you have to identify these risks. You have to measure how much changes were there. You have to then say, okay, I have some 200,000 securities, and for each of these securities, this is the amount of money that I may lose. I should have capital adequacy. So instead of buying 80% of the total deposits into the securities, I should have kept some amount in spare, at least when the interest rates have started rising. So all these things could have been done, and they were not done because there is, we can't say they are bad. This is bad. This is good. There is nothing called bad and good in this, because no banker, no staffer would say, "I want my bank to fall." No, we have to give some credit to them. Nobody wants their office to fall down, right? So there might have been some genuine mistake that has happened. And that genuine mistake is that the risk is not propagated across the staff, at least employees, at least the officers. Nobody knew how much risk or how much amount of money we will have to shell out. That is the problem. If the risk is not, if the people don't understand that, okay, for example, you are running a restaurant and some rat has died. So what do? You would say, hey, there is a rat that has died, so we can't serve you the food. So for today, the hotel is closed. We will open it tomorrow after sanitizing it. That should have been told. And why did they not identify that there is a rat? Because there was no mechanism in place that can identify where the problem is. It is impossible for humans to keep track of everything, particularly those marketing guys, those selling guys, loan sellers. They're in a competitive field. If there are like some 10 banks that wants to do the business with the prospective customer, so they have to compete with big banks that have huge amount of deposits, huge amount of money power, marketing power, and they have to create a niche among themselves. In that particular spit of that particular zone, the risk should have gone into place. So this is the risk. We can't buy all the securities. Calm down. We can't give all the mortgages that they have asked. Calm down. Or the other thing is, the interest rates are going so up. We should be saving some money just in case. So therefore, we can't give more loans, or therefore we can't do so many things. This thing, what if analysis, what like this, what like this, what is the impact on the balances, what is the impact on our funds? These are all done by software. There are Monte Carlo analysis, there is linear regression, there is reinforcement learning. All those things prevent the banks from going south and establish the risk. But these are all like cost centers. When you think that safety is a cost center for you, then you are like going down south. So what the bank, this situation is not going to go away. Small banks have to do things that big banks won't do, not can't do, won't do. So what should the small banks do in addition to being different from big banks? They should have a huge software investment and try to understand the risk. So there are some floors of compliance and regulatory people in big banks. You may not hire all 100 people or 200 people, as the case may be, but you need that software. You need the software that is for you, for your company. If you don't have it, then you are riding a car without brakes, right? Can you ride a car without brakes? No. In the same way, you have to look into these capital adequacy, these risk measures. These are not cost centers. These are your brakes. They break you. The brakes are more important to car than acceleration. They prevent, at least you don't die, right? With proper brakes, you don't die. You may not move as fast, but you won't die. But if you don't have brakes, then there is a heavy chance that you are going to crash. So small banks have to invest money in technology so that they can come up with the same regulatory and compliance procedures that big banks are doing. There is no running away. Now the compliance has become your marketing tool. Okay, people will have credit worthiness. What is the basic thing between the market risk and credit risk? If you have credit risk, you're dead, right? Nobody is going to give anything to you. You can't do business. So don't take your business from other risks to credit risk. That is a no-no zone. As long as you are able to manage your credit risk, then you're fine. Say, for example, what is managing credit risk means? Say you are getting $1,000 and you are going for a loan. Then make sure that that loan is not more than $350 of your 1,000. So you're minimizing the impact that will happen just in case you lose job for 4 months. You still are able to pay that obligations for 3 months, 4 months. So that's how everybody does. And I think banks, small banks, should invest more in technology, should invest more in compliance. Okay, only then you will survive the big banks. The big banks are not stupid to put a lot of money into compliance. If you look into Goldman Sachs, if you look into, I worked in Goldman Sachs for compliance at some many years ago, and I know how much people are looking into that small things there, but that saved them from a huge turmoil in 2008. So that's another episode, another thing. But keep in mind that banks survive crashes only if they are prepared. And risk and software are your friends through which you prepare for the storm. Okay. Thanks. And hopefully you have enjoyed this show, and we'll talk about the other things. There are more things like interest rates and inflation. There is a signature bank failure, how it happened. Then this Gate Capital, how it failed. And also there is the ring fencing that happened. Why the contagion was contained, quarantined, they quarantined the failure by acting quickly. How did that quarantine happen? We'll talk about all those things in coming episodes. But for now, good day and have a great week ahead. Thank you.